it's like almost like to be so intelligent and be so involved in the traditional finance world, like they can't grasp Bitcoin. Like, what do you think is the thing that holds them back from being able to really understand, that this is not a stock, it's something totally different?
Welcome to Dream Richer. Have you ever wondered why the traditional financial world hates Bitcoin, and perhaps even crypto at large? Traditional investors from Charlie Munger to Peter Schiff to Warren Buffett have all openly humiliated Bitcoin. But where does this criticism all stem from? Besides investors, banks at large have also shown a strong criticism against Bitcoin. Many believe that this is because Bitcoin challenges the entire reserve currency system in a country, no matter what country you are in. Banks are built on creating loans based on fractional reserves. Hence, for every $1 in reserves, they may print an additional $10 in loans. Therefore, they can create money as long as their reserves are in alignment with Fed rules. Bitcoin, on the other hand, does not operate that way. There are only ever going to be 21 million of them, no more. Another reason traditional banks have come to hate Bitcoin is because it generates no wealth for them. Banks make money on transactions. Transferring money with Bitcoin does not require another bank. You can move money from point A to B with a modest fee on Bitcoin. Hence, there are no wire fees or transfer fees for a bank to profit from. By the end of this video, Michael Saylor discusses the real reason that is holding traditional investors back from Bitcoin. If you find the video helpful, then don't forget to subscribe. Let's get right into it.
What do you think is the thing that holds them back from being able to really understand, that this is not a stock, it's something totally different?
A frame of reference. If you have a certain frame of reference and you've always lived in that frame of reference, then things that are moving through your frame of reference look like they're in motion. Whereas if you have a different frame of, maybe a broader frame of reference, and you step back, you interpret it differently. It's like if I kick you off a mountain and you're falling, and you understand the big frame of reference, you understand that gravity is pulling you down. The mountain is not rising. The mountain is not a bubble. The mountain is not rallying. The mountain is, you are falling, right? You're in free fall. So the world's full of, I think, macroeconomists and conventional investors and conventional media, and they have been doing the same thing for 30 years. And they thought that 10 years ago, they modified, tweaked a few models, and they're doing great for 10 years. And in the last 12 months, every financial portfolio, with the exception of long bonds, is generally up. And so if you were smart enough not to be holding 10 to 30-year T-bills for the last 12 months, you can tell yourself that you're a genius, and you can ignore rebuilding all your models. And so I really think the conventional investment community doesn't have this urgent need to throw their models away and rebuild them, because the S&P and the NASDAQ are cushioning this paradigm shift. I think the best example would be, I'm a mainstream investor and I look at my performance over the past 12 months. I think I'm a genius because my stock portfolio has been going up. And so I actually think I'm a really good stock picker. The famous example of, look at what we did in the federal government. We made the stock market go up. So that's a frame of reference. But another frame of reference is, we just devalued the dollar by 30%. Exactly. And the stock market is constant.
One key point of focus on Bitcoin is its volatility. It's one of the most volatile assets on the market right now, since banks tend to be conservative. Their customers expect them to be fiduciary with their deposits. Hence, if your deposit drops in value by more than 30% in a day, that's a big issue for the banks. All in all, cryptocurrency is a new technology to banking. Your local bank or credit union are what we would call high-tech. They are not exactly the ones for cutting edge. Even though they have been dealing in fiat money, unsupported by anything but a promise, most of them are run by people from traditional investment era when tokenization was only science fiction. Hence, most managers cannot get their collective heads around how this all works. Currently, the banks are waiting for the IRS and the Fed to come up with rules. Banks don't do anything without their compliance departments looking it over and waiting for someone else to take the first step.
I've interviewed a lot of people that have, made a lot of money in traditional finance. And it seems like those people, they're very comfortable with how they've made their money. And I think, projecting in the future and thinking about what things are going to look like in technology and with cryptocurrency, they don't even want to think about that. They just want to think about, this is the way I've done it before. This is the way we made our money, and we were happy with that. And those people don't want to change. I mean, if you look at Warren Buffett, for instance, doesn't own a lot of tech stocks. It's a little beyond, his expertise. But in reality, like, that doesn't mean tech stocks were not going to crush it.
I think that people that have lived in stable environments where all of the components, the relationship between debt and equity and currency and real estate and tax, all of those are stable, they can form models and they can form heuristics. And then you can look back at the model and use it. But if I were to change maybe the gravitational constant, right? The force of gravity, if I doubled it or tripled it, all of your architecture textbooks and all of your tables
are wrong.
Building.
Yeah.
And so people get lazy and they live with that little particular solution. And then when one of the premises or one of the boundary conditions changes, all your particular differential equations are worthless. And then you have to derive from first principles or underlying math. And if you're not a good mathematician, or if you're not capable of deriving from first principles, you're a totally fish out of water.
Yeah.
The colloquial example would be, you study kids playing basketball in the school playground your entire life, and you know generally how that ends. And all those models are useful, except when Godzilla shows up to the playground. Yeah, and then it doesn't matter anymore.
It's clear from Michael Saylor's explanation that crypto and Bitcoin in particular is here to stay, regardless of how the traditional investment world currently feels about tokenization. As Mr. Saylor argues, they will catch up inevitably. And when they do, prices are going nowhere but up. Some cryptocurrency experts think that big banks cannot stop Bitcoin, even if they develop their own blockchain. Currently, blockchain is seen as a technology revolution because it is decentralized. Hence, banks have no choice but to adopt Bitcoin. And that can make the digital currency pump in price, as it will open the way for a broad acceptance. What is happening here is disruption, but at a more cautious, manageable pace. Do you think banks will ever begin to adopt Bitcoin? We are already seeing some banks start to back Bitcoin. To learn more about the latest crypto news, watch these videos here.